Episode 1: The Day Confidence Shook. Why Bitcoin's fall feels different this time. There is a specific moment many people remember. Not a price, not a chart, but a feeling. It's the moment they opened their phone, scrolled past the noise, and felt something tighten in their chest. Bitcoin was falling again. But this time, it didn't feel like the other times. It wasn't just fear. It was confusion. Doubt. A quiet question no one wanted to say out loud: what if this time is different? For years, Bitcoin's drops followed a familiar emotional script. Prices fell, panic spread, headlines screamed collapse, and believers repeated a phrase that became almost sacred: zoom out. History rewarded that faith often enough that confidence became muscle memory. Crashes were framed as tests of conviction, rites of passage for those who truly understood Bitcoin. But the recent fall disrupted that rhythm. It didn't arrive like a sudden storm. It crept in slowly, through exhaustion rather than shock. To understand why this fall feels different, you have to understand who is watching now. In Bitcoin's early years, most holders were technologists, libertarians, or risk-tolerant outsiders. Volatility was expected. Losses were painful but almost theoretical. Today, Bitcoin lives in the same mental space as retirement funds, inflation hedges, and national economic conversations. Teachers, delivery drivers, small business owners, and parents didn't enter Bitcoin chasing rebellion. They entered searching for stability, or at least protection, from a world that already felt unstable. That shift changes everything. When Bitcoin falls now, it doesn't just challenge belief in a technology. It challenges personal decisions. It forces people to confront trade-offs they made between rent and risk, between savings accounts and something they hoped would outpace a system they no longer trusted. The emotional weight is heavier because the stakes are real in everyday life. Consider a real scenario that has played out countless times. A young professional starts investing after watching inflation quietly eat away at savings. Traditional accounts feel stagnant. Bitcoin represents not greed, but participation, a way to avoid falling behind. When prices dip at first, it feels manageable. Normal even. But as weeks stretch into months, something changes. The conversation shifts from opportunity to endurance. Confidence erodes not because of one dramatic drop, but because recovery keeps getting delayed. This slow erosion is what makes the recent fall unsettling. In previous cycles, Bitcoin crashed violently and rebounded loudly. Pain was sharp but brief. This time, the decline feels drawn out, almost psychological. It lingers. It invites second-guessing. People aren't just asking whether Bitcoin will recover, they're asking whether they misunderstood it entirely. Institutions play a role in this emotional shift. When large financial firms, funds, and corporations entered Bitcoin, they brought legitimacy, but also expectations. Bitcoin was no longer just an experiment. It was framed as a mature asset. That framing created an unspoken promise of stability. So when instability returned, it felt like betrayal, not volatility. There's also the broader backdrop no one can ignore. This fall isn't happening in isolation. It's unfolding in a world shaped by economic uncertainty, rising living costs, geopolitical tension, and rapid technological change. For many people, Bitcoin wasn't just an investment, it was a story they told themselves about the future. A story where decentralization offered balance, where math felt more trustworthy than policy, and where individuals had more control. When Bitcoin falls now, it shakes that story. Media coverage amplifies this effect. In the past, Bitcoin crashes were treated as fringe curiosities. Today, they are front-page economic narratives. The language has shifted from volatile experiment to market threat or failed hedge. Even neutral reporting carries emotional weight when it reaches millions who are already uncertain about their financial footing. But beneath the headlines and price movements lies something deeper. This fall feels different because Bitcoin is no longer judged only on its technology, it's judged on its promises. Not promises made officially, but promises inferred by adoption, attention, and cultural meaning. People believed Bitcoin represented resilience. When it struggles, they feel that resilience questioned. Yet history offers a quiet reminder. Confidence has shaken before. In every major phase of Bitcoin's existence, there was a moment when belief fractured. Each time, the reasons felt unique. Each time, the fear felt rational. And each time, The question sounded hauntingly familiar. What's different now isn't Bitcoin itself, it's the audience. More people are emotionally invested, not just financially. More lives intersect with its movements. More expectations sit on its shoulders. A fall that once felt like a technical correction now feels like a social event, a cultural signal, a referendum on trust. This episode isn't about declaring failure or predicting recovery. It's about recognizing why emotions are stronger, reactions are sharper, and doubts feel heavier. Understanding that difference matters. Because markets don't move on numbers alone, they move on belief. And belief is always tested before it is either broken or renewed. As Bitcoin continues its uncertain path, the real question isn't just where the price goes next. It's what this moment reveals about how people think, hope, and fear when the systems they lean on start to wobble. And that question leads directly to the deeper force behind every crash, rally, and recovery, the human mind itself. Episode 2: Fear, Greed, and the Human Psychology Behind Every Bitcoin Crash. Long before Bitcoin existed, long before charts glowed on screens and notifications buzzed in pockets, the forces that drive its crashes were already shaping human behavior. Fear and greed are older than money itself. Bitcoin didn't invent them. It simply exposes them in real time, with nowhere to hide. Every major Bitcoin crash begins the same way, not with panic, but with confidence. Confidence builds quietly. Prices rise, stories circulate, and early success feels like proof of understanding rather than timing. People don't say they're lucky. They say they were right. That distinction matters, because it's the seed of overconfidence, and overconfidence is where psychology starts bending reality. Consider a familiar situation. Someone invests a modest amount, watches it grow, and feels validated. That growth changes behavior. Risk tolerance increases. What once felt speculative now feels inevitable. This isn't greed in a cartoonish sense. It's psychological anchoring, the mind adjusting its expectations upward. Gains feel normal. Anything less feels like loss, even if the person is still ahead. This is how the emotional cycle tightens its grip. When Bitcoin begins to fall, the first reaction isn't fear. It's denial. Investors tell themselves the drop is temporary, that they've seen this before. They scroll social media searching for reassurance, selectively absorbing opinions that confirm their hope. This phase is comforting, but dangerous. It delays action and deepens emotional exposure. As prices continue to slide, denial gives way to anxiety. Anxiety doesn't arrive as panic, it arrives as obsession. People check prices constantly. Sleep is interrupted. Conversations drift back to Bitcoin even when no one wants them to. The mind becomes hyper-focused because uncertainty feels like a threat, and the brain evolved to fix threats fast, even when no solution exists. At this stage, fear starts competing with pride. Selling now would mean admitting a mistake. Holding means enduring discomfort. Many choose the latter, not out of strategy, but out of identity protection. Behavioral psychologists call this loss aversion. The pain of losing feels stronger than the pleasure of winning. In Bitcoin crashes, loss aversion traps people longer than logic ever could. Then comes the tipping point. This is where fear overtakes hope, and markets feel it instantly. The moment people stop asking, "Will it recover?" and start asking, "What if it never does?" Selling accelerates not because fundamentals changed, but because collective psychology did. Bitcoin falls faster at this stage because fear spreads socially. One person's panic becomes another's confirmation. Real-world examples make this painfully clear. During major downturns, online forums fill with identical posts written by different people. Regret, confusion, anger at themselves. Some describe investing money they didn't need urgently, yet still feeling devastated. Others admit they believe they were emotionally prepared, only to discover that real losses feel nothing like imagined ones. This reveals an uncomfortable truth. Most people overestimate their risk tolerance. On paper, volatility sounds manageable. In practice, watching savings shrink tests emotional resilience more than financial literacy. Greed, meanwhile, doesn't disappear during crashes. It mutates. As prices fall, a new narrative emerges: opportunity. Some rush in, convinced they are smarter, calmer, or braver than those selling. Sometimes they are right. Sometimes they underestimate how long fear can dominate a market. Greed whispers that timing the bottom is possible. Psychology ensures it's rare. Bitcoin's transparency intensifies these emotions. Unlike traditional markets that close at night, Bitcoin never sleeps. There is no emotional pause, no reset. Fear can compound at 3 a.m., and greed can spike during lunch breaks. The constant availability amplifies impulsive decisions, making psychology an even stronger force. Social media adds another layer. Platforms reward extreme emotion, certainty, outrage, triumph. Calm voices struggle to compete. During crashes, this creates echo chambers where fear and greed bounce endlessly between users, accelerating market movements beyond what fundamentals alone would justify. But psychology doesn't only affect individuals. It shapes entire market cycles. When fear dominates long enough, participation drops. Attention fades. Bitcoin stops being discussed at dinner tables and in news cycles. This emotional exhaustion phase is often mistaken for disinterest, but it's actually collective burnout. People disengage to protect themselves emotionally. Historically, this is where markets begin to stabilize, not because optimism returns, but because fear runs out of energy. Understanding this cycle doesn't make anyone immune to it. Even seasoned investors feel it. Experience doesn't remove emotion, it simply teaches recognition. The difference between those who survive Bitcoin crashes and those who don't isn't intelligence, it's emotional management. Bitcoin is often framed as a technological experiment, but its price movements are a psychological mirror. Every rise reflects human optimism. Every fall reflects human vulnerability. The technology stays the same. The emotions do not. This is why every crash feels personal. Bitcoin doesn't just test financial strategies, it tests patience, identity, and self-trust. It forces people to confront uncomfortable questions about why they invested in the first place. Was it belief? Fear of missing out? Distrust of traditional systems? Hope for a shortcut? Those answers matter more than price charts ever will. As we move forward in this series, the focus widens. Psychology explains individual behavior, but it doesn't act alone. Larger players, institutions, and systems now shape Bitcoin's emotional landscape in ways that didn't exist before. And when big money enters a market built on human emotion, the results are anything but simple. Episode 3: From Wall Street to Main Street: How Institutions Changed Bitcoin's Behavior. There was a time when Bitcoin moved in ways that felt almost personal. Price swings seemed driven by online forums, tech conferences, and small groups of early believers. It was chaotic, unpredictable, and undeniably wild. Then, quietly at first, a different kind of participant arrived. Institutions didn't enter Bitcoin with excitement or ideology. They entered with spreadsheets, risk models, and one simple question: does this asset belong in our system? That question changed Bitcoin forever. When large financial institutions first showed interest, many retail investors celebrated. It felt like validation. Bitcoin was no longer just an outsider experiment. It was being acknowledged by the very structures it once sought to challenge. Funds, banks, and asset managers brought legitimacy, liquidity, and scale. But they also brought something less visible: new behavior patterns that reshaped how Bitcoin rises and falls. Institutional money doesn't move like individual money. It doesn't react emotionally to headlines or social media sentiment. It reacts to mandates, risk exposure, and macroeconomic signals. This difference matters, especially during downturns. Imagine a pension fund or large asset manager holding Bitcoin exposure. When broader markets weaken, or when interest rates shift, Bitcoin isn't evaluated in isolation. It's evaluated alongside equities, bonds, and commodities. If risk needs to be reduced across the board, Bitcoin becomes part of that decision, not because of its technology, but because of its classification as a risk asset. This is one reason recent Bitcoin falls feel synchronized with global markets. In earlier years, Bitcoin often moved independently. Now, it frequently moves in step with broader financial sentiment. For retail investors who believed Bitcoin would always act as a hedge or alternative, this correlation feels confusing, even disappointing. Real-world examples show how this plays out. During periods of economic tightening, institutional portfolios rebalance. Assets perceived as volatile are trimmed first. Bitcoin, despite its long-term narrative, often falls into that category. These decisions happen quietly, automatically, and at scale. Millions or billions can move without a single emotional tweet. That scale amplifies impact. Another shift institutions introduced is time horizon mismatch. Retail investors often think in personal timelines, months, years, life goals. Institutions think in quarters, performance reports, and regulatory cycles. When results underperform, adjustments are made quickly. This creates pressure on Bitcoin's price that has nothing to do with long-term belief and everything to do with short-term accountability. This structural pressure makes downturns feel heavier and longer. There's also the rise of financial products tied to Bitcoin. Funds, trusts, and exchange-traded instruments made access easier but also abstracted ownership. Many people now gain exposure without ever holding Bitcoin directly. That abstraction changes behavior. When ownership feels distant, selling feels easier. The emotional bond weakens, and market movements accelerate. At the same time, institutions brought professionalism. Custody improved. Infrastructure matured. Compliance increased. These developments reduced certain risks but introduced others. Bitcoin became entangled with the same systems it once stood apart from. When those systems wobble, Bitcoin feels the tremors. For Main Street investors, this shift creates cognitive dissonance. Bitcoin is still described as decentralized, yet its price reacts to centralized decisions. It's framed as independent, yet it responds to interest rates and policy signals. This contradiction fuels frustration during downturns. People expected Bitcoin to behave differently. Instead, it started behaving more like everything else. That doesn't mean institutions broke Bitcoin. It means they integrated it. Integration comes with trade-offs. Wider adoption brings stability in some areas and vulnerability in others. The market becomes deeper but more complex. Movements become less dramatic day to day, but more powerful when they happen. There's also a cultural shift. Early Bitcoin culture emphasized patience, self-custody, and long-term thinking. Institutional involvement emphasizes performance, exposure, and efficiency. Neither is inherently wrong, but the tension between them becomes visible during crashes. When prices fall, retail investors look for reassurance rooted in belief. Institutions look for justification rooted in data. These perspectives rarely align in the moment, creating emotional whiplash for individuals watching from the sidelines. Understanding this dynamic reframes the recent fall. It's not just a loss of confidence, it's a clash of timelines and priorities. Bitcoin now sits at the intersection of ideology and infrastructure. Its price reflects that tension. The journey from Wall Street to Main Street didn't make Bitcoin weaker. It made it more complex. And complexity means fewer simple explanations when things go wrong. Episode 4: Regulation, Power, and Control. Governments versus Decentralized Money. Bitcoin was born from a moment of distrust. Its earliest ideas took shape in the shadow of financial collapse, when confidence in banks, bailouts, and centralized authority was deeply shaken. At its core, Bitcoin wasn't just a new kind of money. It was a challenge to how power over money had always been organized. That challenge was bound to provoke a response. Today, as Bitcoin falls under the weight of uncertainty, regulation sits at the center of the tension. Governments don't experience Bitcoin emotionally. They experience it strategically. From a regulatory perspective, Bitcoin raises uncomfortable questions. Who controls it? Who is responsible when things go wrong? How does it fit into existing legal and financial frameworks built on oversight and accountability? These questions don't disappear just because a technology is decentralized. In fact, decentralization makes them louder. When governments speak about Bitcoin, markets listen, not because regulation changes the technology, but because it changes behavior. Even the possibility of new rules can move prices. Uncertainty alone is enough. For investors, regulation represents both protection and restriction, and it's often unclear which will dominate. Real-world examples illustrate this perfectly. When major economies signal tighter oversight, whether through taxation rules, reporting requirements, or restrictions on exchanges, Bitcoin markets react instantly. Not because Bitcoin stops working, but because access becomes more complicated. Liquidity tightens. Participation slows. Fear grows quietly, especially among those who depend on ease of use rather than ideology. For everyday investors, regulation feels personal. It determines whether an app remains available, whether transactions feel safe, and whether participation comes with legal anxiety. At the same time, governments face their own pressures. Bitcoin challenges traditional monetary tools. It operates outside central banks' direct control, yet influences capital flows and public sentiment. In times of economic stress, authorities are especially sensitive to anything that weakens confidence in national currencies or financial systems. This creates a fundamental clash of incentives. Bitcoin's design resists central control. Governments are built around it. Neither side is inherently villainous. Both are responding to their nature. But when these forces collide, markets feel the friction. The recent fall highlights this tension more clearly than ever. Bitcoin is no longer small enough to ignore, yet not integrated enough to fully accommodate. It exists in a regulatory gray zone that keeps investors guessing. Each announcement, proposal, or enforcement action adds weight to that uncertainty. There's also a narrative battle at play. Supporters frame Bitcoin as financial freedom. Critics frame it as instability or risk. Governments often frame regulation as protection, protecting consumers, markets, and economic order. All three narratives can be true at once, which is what makes the debate so emotionally charged. For many investors, regulation breaks the illusion of autonomy. Bitcoin promised a system beyond traditional gatekeepers. Regulation reminds people that interaction with the real world, exchanges, taxes, laws, still matters. This realization can feel like a betrayal of the original dream, especially during downturns when confidence is already fragile. Yet regulation also signals permanence. Governments don't regulate things they expect to disappear. Every framework proposed, every guideline debated, quietly acknowledges Bitcoin's staying power. This paradox confuses markets. Regulation threatens freedom but confirms relevance. History shows that markets fear uncertainty more than restriction. Clear rules, even strict ones, often stabilize behavior over time. But clarity takes time, and during that waiting period, volatility thrives. Bitcoin's fall reflects this waiting. Investors are caught between two futures, one where Bitcoin integrates into existing systems, and one where it remains an alternative outside them. Each path has consequences. Each reshapes expectations. And until that path becomes clearer, hesitation remains baked into the market. This episode isn't about choosing sides. It's about understanding why regulation carries such emotional weight. Bitcoin isn't just reacting to laws, it's reacting to the question of control. Who gets to decide how money works? Who sets the rules when technology moves faster than policy? Those questions don't get answered in a single market cycle. They unfold slowly, through debate, compromise, and resistance. And while that process continues, Bitcoin's price will continue to reflect not just economic forces, but philosophical ones. As regulation presses in from above, another influence pulls from the side, one that doesn't make rules or trade assets, but shapes perception itself. The stories people hear, repeat, and believe matter more than ever. That influences the media, and its role in turning corrections into panic is next. Episode 5: The Media Effect: How Headlines Turn Corrections into Panic. Most people don't experience Bitcoin through charts or white papers. They experience it through headlines. A notification flashes across a screen. A bold sentence appears in a feed. Sometimes that sentence informs. Other times, it ignites fear long before facts can catch up. Media doesn't cause Bitcoin to fall, but it often determines how the fall is felt. In traditional finance, market corrections are expected, analyzed, and contextualized. In the world of Bitcoin, those same movements are often framed as dramatic turning points. Words like crash, collapse, or meltdown appear quickly, even when the underlying move fits historical patterns. This framing matters because it shapes emotional reactions, especially among casual participants. Imagine someone who doesn't follow Bitcoin daily. They're not watching charts, they're living their life. Then a headline appears: Bitcoin plunges amid growing concerns. No context. No scale. Just urgency. That person reacts emotionally first, intellectually later, if at all. Fear doesn't wait for nuance. This is how media accelerates panic. The pressure to capture attention drives this behavior. Bitcoin is clickable. It's controversial. it carries cultural weight. A calm explanation rarely spreads as far as a dramatic warning. Algorithms reward intensity, not accuracy. As a result, corrections become crises in the public imagination. Real-world examples revealed the pattern clearly. During recent downturns, identical stories appeared across platforms, each amplifying the same narrative with slightly different wording. Social media users shared them without reading past the headline. Fear spread horizontally, not vertically. Understanding wasn't deepened, it was multiplied. This effect is especially powerful for retail investors who lack emotional distance. When uncertainty already exists, negative coverage feels like confirmation. People don't ask whether the headline reflects new information, they assume it does. Selling decisions follow perception, not analysis. Media also simplifies complex causes into single explanations. A drop becomes, because of regulation, or because of institutional selling, or because confidence is gone. Reality is almost always more layered. But simplicity is persuasive. It gives people something to blame and something to fear. Over time, this repetition conditions audiences. Bitcoin becomes associated with instability in the collective mind, even during periods of growth. So when prices fall again, the reaction is faster, sharper, and more emotional. The story is already written. There's another side to the media effect that's less obvious. During bull markets, positive coverage inflates expectations. Success stories dominate. Skepticism fades. When the market turns, those inflated expectations collide with reality. The fall feels steeper not just financially, but emotionally. This boom and bust storytelling cycle creates whiplash. Viewers swing between euphoria and despair, often without tools to process either. Bitcoin becomes a source of stress rather than understanding. For content creators, journalists, and commentators, responsibility is complicated. Reporting market movements is necessary. Ignoring Bitcoin isn't an option anymore. But framing choices matter. Context matters. Tone matters. When every downturn is treated as existential, trust erodes, not just in Bitcoin, but in information itself. Audiences feel this erosion. Many people now approach Bitcoin news with skepticism, unsure whether they're being informed or manipulated. That distrust feeds anxiety during crashes. People don't know who to believe, so they react faster than they think. The recent fall highlights how deeply perception shapes reality. Price movements and media narratives feed each other in a loop. A drop triggers headlines. Headlines trigger selling. Selling deepens the drop. The cycle reinforces itself until exhaustion sets in. Understanding this dynamic doesn't mean ignoring bad news. It means recognizing emotional amplification when it happens. Bitcoin doesn't move in a vacuum, and neither does public sentiment. Episode 6: Retail Investors' Reality: Stories of Loss, Hope, and Survival. Behind every market movement are people living ordinary lives. They aren't trading desks or algorithms. They're parents checking balances after work, students learning about money for the first time, and workers hoping their decisions today might make tomorrow easier. When Bitcoin falls, it doesn't just erase numbers, it reshapes emotions, routines, and self-trust for millions of retail investors. One of the most common stories begins quietly. Someone hears about Bitcoin through a friend, a podcast, or a headline. They don't jump in immediately. They watch. They learn just enough to feel informed but not enough to feel confident. Eventually they invest, not recklessly, but deliberately. The amount matters to them. It represents effort, time, and belief. At first, everything feels manageable. Volatility is expected. Gains feel validating. Losses feel temporary. But as the market turns and stays down, that calm begins to crack. The investment stops being abstract and starts becoming emotional. People replay decisions in their minds, wondering if they entered too late, misunderstood the risk, or trusted the wrong voices. Loss, in this context, isn't just financial. It's psychological. Many retail investors describe feeling embarrassed during downturns. They don't talk about their investments anymore. They stop checking prices in public. Some hide their anxiety from family members, especially if the decision to invest felt personal or symbolic. This silence deepens isolation, making the experience heavier than it needs to be. Yet not every story is one of regret. Some investors find resilience in the downturn. They reflect on why they invested in the first place. For them, Bitcoin wasn't a shortcut, it was an education. Loss becomes a teacher, not a verdict. These individuals adjust expectations, manage emotions, and continue learning. The difference between these paths often comes down to preparation, not financial, but emotional. Those who entered expecting certainty struggle more than those who expected uncertainty. Real-life examples show both extremes. There are stories of people who invested money meant for emergencies, hoping to accelerate progress, only to feel trapped when prices fell. There are also stories of individuals who invested modestly, accepted volatility, and used downturns as moments of reflection rather than panic. Bitcoin doesn't treat these investors differently. The market moves the same for everyone. What differs is how people experience it. Social comparison intensifies these emotions. During bull markets, success stories dominate. During crashes, silence follows. People assume everyone else is coping better, selling smarter, or suffering less. This perception fuels self-doubt, even when it's inaccurate. Retail investors also face an information gap. Institutional players have teams, data, and access. Retail investors have opinions, headlines, and emotion. During downturns, this imbalance becomes painfully obvious. People feel outmatched, as if the game changed without warning. Yet retail participation remains central to Bitcoin's identity. Without everyday users, Bitcoin would lose its cultural relevance. The challenge is helping those users survive emotionally, not just financially. Survival doesn't mean avoiding losses entirely. It means learning to endure uncertainty without losing perspective. It means separating self-worth from market performance. These lessons aren't taught in charts or tutorials. They're learned through experience, often painfully. Some investors step away entirely after downturns. They sell, disengage, and move on. This isn't failure, it's a response. Markets aren't suited for everyone, and recognizing personal limits is a form of strength. Others stay, but change how they engage. They reduce exposure, slow down consumption of news, and focus on understanding rather than reacting. This group often emerges calmer, not because markets improved, but because their relationship with risk matured. Bitcoin's fall exposes these personal crossroads. It forces people to confront why they participate and what they're willing to endure. For many, the answer isn't about money, it's about control, agency, and trust in oneself. These human stories rarely make headlines, but they define Bitcoin's real impact. The market isn't just a financial system, it's a shared emotional environment. As we move forward, the focus shifts again, from individuals to forces that operate invisibly beneath the surface. While retail investors feel every movement, others influence those movements without ever feeling them emotionally. Those forces, whales, algorithms, and structural dynamics, shape the market in ways most people never see. That hidden layer comes next. Episode 7: Whales, Algorithms, and Market Manipulation explained simply. To most people watching Bitcoin, the market looks chaotic. Prices rise and fall, news breaks, emotions flare. But beneath that surface chaos is a structure few retail investors ever see. It's shaped by scale, speed, and automation. This is where whales and algorithms operate, quietly influencing movements that feel sudden and personal to everyone else. A whale isn't a villain or a myth. It's simply a participant with enough capital to move markets. When a whale buys or sells, the impact ripples outward. Liquidity shifts. Prices react. For small investors, this can feel unfair, like playing a game where some players can tilt the board. Imagine a market with thousands of small boats and a few massive ships. When a ship turns, the water moves differently. Smaller boats don't cause waves like that. Bitcoin's market works the same way. Whales don't act on emotion. They act on strategy. Their decisions are often tied to portfolio management, risk exposure, or long-term positioning. When Bitcoin falls, it's not always because belief is lost. Sometimes it's because a large holder adjusted exposure, triggering automated responses across the market. Algorithms amplify this effect. Most modern Bitcoin trading is automated. Algorithms execute trades based on predefined rules: price levels, momentum, volume. They don't think. They don't hesitate. When certain conditions are met, they act instantly. One large sell can trigger dozens of automated reactions, cascading into sharp price moves. To a retail investor watching from the outside, this looks like panic. In reality, it's mechanical. This structure explains why Bitcoin sometimes drops faster than logic suggests. It's not thousands of individuals deciding to sell simultaneously. It's systems reacting to systems, removing human judgment from the equation. Market manipulation is often discussed in emotional terms, but it's usually structural rather than malicious. Whales don't need to conspire. Their size alone creates influence. Algorithms don't intend harm. They simply follow instructions. The outcome, however, feels the same to those caught in the movement. There are real-world moments that illustrate this clearly. Sudden drops occurring without major news often confuse investors. Hours later, explanations emerge: liquidations, margin calls, automated selling. By then, the emotional damage is done. This dynamic widens the gap between perception and reality. Retail investors feel targeted, even when no one targeted them specifically. The market doesn't see individuals. It sees volume. Understanding this doesn't eliminate frustration, but it reframes it. Bitcoin's volatility isn't always a reflection of belief or fear. Sometimes it's simply structure at work. The rise of leverage intensifies this effect. Borrowed positions create fragile conditions. When prices move against them, forced liquidations occur automatically. These liquidations push prices further, triggering more liquidations. It's a feedback loop built on speed, not sentiment. For everyday investors, this creates emotional whiplash. Price movements feel exaggerated and unpredictable. Confidence erodes because logic seems absent. But logic exists, it's just not human logic. This episode of Bitcoin's fall highlights how far the market has evolved. Early Bitcoin moved slowly because humans were in control. Modern Bitcoin moves fast because systems are. This evolution brings efficiency but removes softness. Those who expect fairness feel betrayed. Those who expect structure feel challenged, but not shocked. Bitcoin doesn't promise equal influence. It promises open participation. The distinction matters. As unsettling as whales and algorithms can feel, they aren't the whole story. Markets shaped by structure still exist within history. Patterns repeat. Crises echo. And understanding where Bitcoin fits in the long arc of financial behavior adds perspective to the present moment. To see that perspective, the story must zoom out, beyond Bitcoin itself, and into the broader history of financial crises and human response. That comparison is next. Episode 8, Bitcoin versus History, comparing this fall to past financial crises. Bitcoin's recent fall might feel unprecedented to anyone scrolling charts or refreshing feeds late at night. But in reality, it's part of a much larger story, one that stretches back centuries. To understand why today feels so intense, it helps to step back and see Bitcoin as part of a recurring human pattern: the rise and fall of financial assets under pressure. History is filled with examples of markets that spiked, then crashed, often in ways that seemed incomprehensible at the time. The Dutch tulip mania in the 1600s, for instance, saw tulip bulbs sell for what would now be equivalent to hundreds of thousands of dollars. Prices soared because people believed they would keep rising. When confidence broke, the collapse was dramatic and sudden. Panic was contagious. Sound familiar? Swap tulips for Bitcoin, and the emotional dynamics are remarkably similar. Then there's the South Sea bubble of the 18th century, a company promising unprecedented returns, a market fueled by speculation, and a crash that wiped out fortunes. The psychology was striking. Early success bred overconfidence, narratives justified irrational decisions, and ordinary people suffered most. Again, Bitcoin follows a familiar rhythm. The numbers and technologies change, but the human behavior, the fear, the greed, the hope, is largely the same. Modern crises follow similar patterns. The 2008 financial collapse wasn't about tulips or speculative companies. It was about mortgages and systemic debt, but it was still driven by trust, belief, and perceived scarcity. When people realized their assumptions were flawed, panic spread. Banks, investors, and everyday people alike felt the shock. Losses were both financial and emotional, exactly as retail investors experience in Bitcoin downturns today. These historical echoes offer perspective on Bitcoin's fall. It isn't evidence of failure. It's evidence that markets are social constructs, deeply intertwined with human psychology. Volatility is normal, and crashes are predictable, because human behavior repeats itself, even when the instruments are new. There's another layer, too: recovery. History shows that markets often rebound, but rarely in ways that satisfy every participant. Some recover quickly, others take decades. Timing is unpredictable. The lesson is clear: patience, observation, and emotional resilience matter more than precise predictions. Bitcoin adds a unique twist to this historical comparison: speed and transparency. Crashes that once unfolded over months or years now occur within hours or days. News spreads instantly, emotions amplify, and reactions are global. This acceleration makes the fall feel more intense, even when the underlying dynamics mirror past crises. Yet, despite the rapidity, Bitcoin still follows the same human patterns. People buy when hope is high, sell when fear dominates, and struggle to separate the two. Institutions amplify these cycles through leverage, automation, and global reach. Retail investors feel the weight of both past behavior and modern technology simultaneously. Case studies from recent Bitcoin downturns reinforce this lesson. When prices fell sharply in 2018, many investors experienced the shock of too much, too fast. Yet over the next few years, recovery occurred, not because markets ignored human emotion, but because patterns of adoption, trust, and learning continued. The lesson was clear: history doesn't repeat exactly, but it rhymes. Understanding Bitcoin through this historical lens helps investors and observers alike. Emotional intensity is expected. Volatility is normal. Crashes are not failures, they're part of the process. History also reminds us that learning to respond thoughtfully, rather than react impulsively, is the most reliable path through uncertainty. Looking forward, this historical perspective frames one question more sharply than any chart or headline could: what does Bitcoin teach us about money, trust, and human behavior that no other asset has? Beyond price, beyond gains or losses, the story is about understanding patterns, psychological, structural, and social, that define all markets. Episode 9: Trust, Technology, and the Long-Term Question of Digital Money. Bitcoin isn't just a currency. It's a question about trust, technology, and the way humans organize value. Unlike dollars or euros, Bitcoin isn't issued by a government. Unlike gold, it isn't physical. It exists as code, distributed across thousands of computers, secured by cryptography. That combination of innovation and abstraction is powerful, but it also raises an unavoidable question: can people trust it long term? Trust is at the heart of every financial system. Historically, it came from authority. Banks promised security. Governments promised stability. Even cash itself carries the implicit guarantee of a sovereign entity. Bitcoin removes most of those traditional anchors. It asks participants to trust math, networks, and consensus mechanisms instead. That's revolutionary, but it's also unsettling. For everyday investors, this is deeply personal. Trust isn't abstract, it's practical. People ask, will I be able to access my Bitcoin tomorrow? Will my holdings maintain value? Can I rely on this system when life changes? The fall in Bitcoin's price doesn't just shake confidence in wealth, it shakes confidence in the system itself. Technology is both the solution and the challenge. Blockchain ensures transparency, immutability, and security. Hacks are difficult, yet not impossible. Wallets provide control, yet mistakes in handling can be devastating. The innovation that makes Bitcoin attractive also demands literacy, responsibility, and patience. This duality creates emotional stakes that feel higher than in traditional finance. Trust and technology intersect in real-world ways. Consider exchanges. When a platform fails or is hacked, thousands of people lose access to their holdings overnight. Even when Bitcoin itself remains secure, the ecosystem's vulnerabilities become visible. This erodes confidence, reminding everyone that trust isn't just about code, it's about human systems surrounding the code. Governments and institutions further complicate this picture. Their involvement can strengthen trust, through regulation, insurance, or legal frameworks, but it can also undermine it, introducing fear of control or restriction. Bitcoin exists in a delicate balance between independence and integration, between freedom and stability. That balance is tested every time markets fluctuate. Long-term viability isn't just technical, it's cultural. Bitcoin succeeds when people believe in it collectively. Price matters, but shared perception matters more. When confidence grows, adoption spreads. When confidence falters, even minor corrections feel catastrophic. The recent fall is as much a test of belief as it is of technology. Human stories illustrate this vividly. Some investors hold Bitcoin not for immediate gain, but for the principle of decentralized money. Their commitment is philosophical as much as financial. Others treat Bitcoin as a lifeline in uncertain economies, where trust in national currencies is fragile. Both groups feel vulnerability when prices fall, yet the emotional root is the same: trust is being tested. Technology can reinforce trust. Improvements in wallets, exchanges, and infrastructure make participation safer and more accessible. But no system is perfect. Failures are amplified because Bitcoin is global, real-time, and highly visible. Every mistake, hack, or technical glitch becomes a lesson in the fragility of digital trust. The broader question is whether society can internalize this new form of confidence. Traditional money relies on institutions, hierarchies, and history. Bitcoin relies on networks, cryptography, and consensus. Both systems require faith, but in very different ways. Understanding this difference is crucial for interpreting Bitcoin's behavior and its recent fall. Ultimately, Bitcoin's long-term question isn't about price, charts, or speculation. It's about human psychology meeting technology at scale. Can people trust something that exists purely as code? Can collective belief be sustained through volatility, misinformation, and structural shocks? Every crash answers that question in small ways, shaping how future participants approach, perceive, and value digital money. The recent fall isn't a failure, it's a test. It's a moment where trust is measured against uncertainty, where technology's promise meets reality, and where individuals confront the emotional cost of participating in something entirely new. How they respond will shape not just Bitcoin's future, but the future of money itself. Episode 10: What Bitcoin's Fall Teaches About Money, Risk, and Human Nature. Every Bitcoin crash tells a story, but the story isn't only about technology, finance, or price. It's about people. About our decisions, our emotions, and the ways we interact with uncertainty. After watching the rise and fall, the crashes and recoveries, the headlines, and the psychological twists, one thing becomes clear: Bitcoin is a mirror, reflecting human nature as much as it reflects market forces. At its core, money is trust. Traditional currencies rely on centuries of institutional credibility. Bitcoin relies on math, networks, and shared belief. When Bitcoin falls, it isn't just numbers changing, it's confidence being tested. Retail investors feel it in their wallets and their emotions. Institutions feel it in their strategies. Whales and algorithms feel it in their execution. Every participant is influenced, not always consciously, by perception, narrative, and psychology. The first lesson is that risk is emotional, not just financial. Numbers on a screen can be analyzed with logic, but losses feel personal. Fear, regret, and hope shape decisions faster than reason. This is why crashes often feel worse than they are, and why recoveries sometimes surprise. Understanding risk requires acknowledging its emotional weight. Ignoring that dimension is how mistakes compound during crises. Second, human behavior repeats across time. History shows tulip mania, the South Sea bubble, and 2008's financial collapse. All echo patterns now visible in Bitcoin. Overconfidence, herd behavior, fear of missing out, and panic selling are constants. Technology may change speed, scale, and visibility, but human reactions stay remarkably familiar. Recognizing these patterns helps interpret events, even when the market feels chaotic. Third, Bitcoin teaches that trust is fragile yet resilient. Individuals, institutions, and networks can lose confidence suddenly. But trust can also rebuild. People learn from experience, systems improve, and adoption persists. The fall may feel catastrophic, but it doesn't erase the foundational principles that support digital money: transparency, decentralization, and verifiable scarcity. These principles endure even when prices wobble. Fourth, control is often an illusion. Investors learn quickly that they cannot dictate the market. Algorithms, whales, institutions, regulation, and global sentiment move prices in ways that feel beyond individual influence. Yet, the aspect that can be controlled is personal: preparation, education, emotional discipline, and strategy. Survival depends less on predicting the market than on managing oneself within it. Fifth, resilience is cultivated through experience. Retail investors who weather crashes often emerge wiser, calmer, and more informed. They learn to separate identity from investment, patience from impulsivity, and principle from hype. This resilience is a form of personal growth that outlasts any single price movement. Bitcoin, in this sense, is a teacher disguised as a market. Case studies highlight these lessons vividly. Families who survived downturns without financial ruin often did so through planning, measured exposure, and emotional control. Early adopters who endured multiple cycles developed a long-term perspective that allowed them to view each fall as temporary rather than terminal. Even those who lost significant capital often describe the experience as transformative, shaping how they think about money, risk, and decision-making forever. Finally, Bitcoin challenges how we think about the meaning of money itself. It strips away the comfort of centralized authority and demands participation in a system built on consensus and belief. In the end, the story of Bitcoin's fall isn't just a financial narrative. It's a human narrative. It's about how people react when promises, perceived or real, are tested. It's about fear and hope, mistakes and learning, uncertainty and courage. The market moves, but the lessons remain. Emotion drives behavior, history rhymes, trust matters, control is limited, and resilience is everything. Watching Bitcoin rise and fall is like watching a mirror of human nature. And if there's one enduring takeaway, it's this: the market will continue to test us, but how we respond defines not only our financial outcomes, but our growth, awareness, and understanding of what it truly means to navigate risk and uncertainty. Bitcoin may fall. Prices may wobble. Headlines may panic. But the insights it provides, about money, risk, and the human condition, are timeless. And that is a lesson no crash can erase.